Really, my goal today and kind of the overarching goal that I want to achieve today is just really to encourage the audience today to plan for taxes and be proactive about getting ready for taxes. You don't want to just report the score of the game on April 15th. You want to be working today to influence the score of that game.
Welcome, everybody, back to another exciting show of the About That Water podcast. I'm your host, Anthony Weaver, and this podcast is for the sandwich generation to help them build confidence so that they can talk about money, enjoy their money, and spend their money. So today, I have an awesome opportunity to bring on somebody pronounced by Kyle Beltle. So, who actually owns the Proactive CPA, which is focused on custom tax strategies, plans to help entrepreneurs keep more of what they earn so that they can pretty much invest that with their families and their business. So how you doing today, Kyle?
Hey, I'm doing well, Anthony. Thank you so much for having me on the show. It's a pleasure to be here.
Yeah. So the biggest thing about taxes, why do we got to pay them?
Yeah, that's a great question. If you look back at the history of taxes, and you'll have to fact check me on this there, but I want to say it wasn't until around like the Civil War that we even had income taxes there. You know, we went many years without them there, but yeah, now they are a part of our lives for better or for worse, and for most people for worse, right?
Right. So, because we got to pay them either which way, but as a business owner, what are it's going to just jump right into it. What are the top 4 strategies that every entrepreneur needs to know to take advantage of?
Yeah. Well, Anthony, really my goal today and kind of the overarching goal that I want to achieve today is just really to encourage the audience today to plan for taxes and be proactive about getting ready for taxes there. And to use a sports analogy, you don't want to just report the score of the game on April 15th. You want to be working today to influence the score of that game. There's so many things in life that we plan and prepare for. And I really want to encourage people to really make taxes one of those things. And so a lot of people are asking, well, where do I even start? You know, you get on, depending on what your algorithm is feeding you on the socials there, you know, a lot of people, especially business owners, are seeing this tax advice. You know, they don't know if it applies to them. They don't know if it's even legal in some cases. So where do you even start, Anthony? So here's my 4 top tips for if you are an entrepreneur, you own your own business, where do you get started? And those would be, first off, entity selection for your business. Second, are you taking the full QPI deduction? Third, are you taking advantage of pass-through entity tax? And fourth, are you maxing out your retirement contributions? And would you mind if I share kind of a quick story behind each of those, Anthony?
Yes. So, because I was about to say, what? Can you go in detail some more?
Yeah. Everyone's like, oh yeah, pass-through entity tax, of course. So entity selection. I was recently working with a woman named Emma who came to me. She brought her tax return, and I was looking at how her business was being taxed. In the technical terms, she was being taxed as a sole proprietor. And as I was crunching the numbers, I realized, hey, making an S election and being taxed as an S corp would actually be better for her, to the tune of she was missing out on about $5,000 savings every year. And so I asked her, just to kind of understand, because we were new working together, I just said, just out of curiosity, why are you being taxed as a sole prop? And she said, well, I don't know. That's just the way I got set up 10 years ago. And I've just been doing that ever since. In the US, there's essentially 4 different ways that a business can be taxed. And just because you started out one way doesn't mean that today that way is still the best for you. So if it's been a while since you talked with your CPA or your EA about how your business is being taxed, really would encourage you to revisit that to make sure that your business entity structure is still the most advantageous for you today. Because like I said, with this woman, Emma, she was losing 5,000 or missing out, I should say, on $5,000 a year in savings.
Yeah.
Assuming her business stayed the same, that's 5,000 this year, 5,000 next year, 5,000 the following. If she grows her business, that's just going to increase those savings year over year, and it just compounds. So make sure you're looking at your entity and that it's being taxed as an advantage. It's being taxed the best way for you as possible.
Now, there was one thing you mentioned was an EA. Can you explain what an EA is?
Yeah, absolutely. And I appreciate you calling me out on that.
It's
Sometimes
okay.
we throw these terms around so much, right? We forget that they're not necessarily common. So EA, that stands for enrolled agent. That is one of the best designations that someone who's a tax professional can get. It is administered by the IRS there, and it just shows a high level of technical excellency, technical competency with the tax code.
Okay.
Yeah.
Yeah. So that's pretty interesting because sometimes we just don't know.
Yeah, exactly. Exactly. Speaking of not knowing, that kind of leads me into the second one that I always want to take a look at and encourage people to be taking a look at, the QBI deduction, or qualified business income deduction. Now, here's how I like to say this, Anthony. Would you believe me if I told you that most business owners are only paying taxes on 80% of their profits?
No.
Yeah, it sounds like a TikTok advice that's too good to be
Right.
true there. But most taxpayers are eligible for the qualified business income deduction, which has a maximum amount of 20% of your business profits there. Thus, if you're able to max that out, you're essentially only paying that tax on 80%. It's a very nuanced rule. There's a lot of layers to it, and it's very easy for people not to be getting that full 20%. To tell you another story, my firm had someone come through our doors, say, "Hey, I'd like to get a quote from you on preparing my taxes next year." Great. Let's see a copy of last year's return, get a sense of what we're working with. There was no QBI deduction whatsoever. And we said to him, just out of curiosity, why didn't you take QBI? He said, well, I self-prepared my return and I didn't know that was a deduction out there. Anthony, it was $25,000 for this individual that they were missing out on just because they didn't know about that. So it's a deduction that most people are eligible for. A great place to start is just making sure you're getting that full 20% there.
Okay. So now this is just for the business owners, right? To make sure that we get that. Okay. That's something that
Yeah, that's correct. But again, maybe you have a business doing $5 million of revenue a year. Maybe you've got an Etsy shop doing $500 a year. Either way, both of those businesses are likely going to be eligible for that deduction. So regardless of how big your business might be, make sure you're taking advantage of that.
Yeah. All right. Well, I'll need to look at that for my podcast.
That's right. Yeah. Make sure you're getting that there. So we talked about entity selection. We talked about QBI. The third one, pass-through entity tax. Okay. So man, that's a mouthful. I'm just going to call it P-TET.
Okay.
That is a deduction for people who are in a state that has state income tax. So all my friends in Florida, Texas, you can go refresh your coffee real quick while we talk about this. But then B, are you in a state that has passed a law allowing P-TET? For example, I'm in Pennsylvania, and Pennsylvania is one of the few remaining states that has not put out a P-TET law. So for the rest of the country, there's a total of 36 states that have implemented this, and then there's a number of states that don't even have income tax. So the majority of the states are taking advantage of this. To give some context, by default, for most taxpayers who own their own business, the default is that the business taxes are being paid on your personal tax return. What P-TET allows you to do is have the business directly pay those taxes to the state. Now, why would we want to do this? Well, it doesn't change the amount of state income tax your business owes. But what it does allow you to do is take a business deduction for those taxes, thus lowering the amount of profit you show at the federal level. Many people are familiar with the SALT cap. SALT stands for state and local tax. So if you're itemizing on your 1040, up until 2024, you were limited to $10,000 of state and local tax deductions. Now with the One Big Beautiful Bill Act, it's going to jump up to $40,000 a year. But for many people running really successful businesses, their state income taxes from their business far exceed that. And so the P-TET allows you to bypass that cap and fully deduct all of your business's taxes. And just to kind of give some color to this, Anthony, I'm working with a prospect right now where if she was not taking advantage of P-TET, I'm going to switch her over to take advantage of that. And simply by making one little election, we're going to save her $15,000 a year on her taxes by allowing her to fully deduct all of her business taxes. So again, if you're in a state with income taxes that allows for a P-TET election there, make sure you're working with your tax pro to make sure your business is taking that so that you're fully maximizing out all of your business taxes.
So
there.
Is that something that we get to ask directly? We're like, hey, did you add the P-TET, or should they know what P-TET is?
Well, yeah, in a perfect world, Anthony, your tax professional should be coming to you and saying, hey, want you to know you're eligible for this, and I think we should make this election to take this there, but sometimes not. And the reason being is this, in tax history, this is relatively recent that P-TET has come around. And so again, if working with a well-established business there, it's so easy to just do what we did last year, rinse and repeat, and not say like, hey, the tax law changed around here. There's something new that we can be taking advantage of here. And so, yeah, just always good to revisit that with your tax pro, make sure has been evaluated.
Okay. And then to make sure that we get that, make sure we ask the question, because that's one of the things that a lot of times going back to, we don't know. Well, that's the reason why we do this show, because taxes change every year.
You don't know what you don't know.
Yeah. So what's the last one?
Sure. So the final thing I always encourage people to do as just a good starting point with being proactive with your taxes, are you maxing out your retirement accounts there? And I know that sounds so simple and it's something often said, but I'll tell you a story about a client named Michael. Michael owned an outdoor products business. They would resell outdoor products. He and I were meeting on a quarterly basis, just talking about the business, how things are going, and planning for the future. And it became very evident early in the year that he was going to have a very profitable year. And so we were looking of ways, how can we minimize his tax liability? Now, in addition to all those profits, he also did not have a lot of uses for cash in his business there, right? Some people have debt that they're paying down, or they have things going on in their personal lives, or they need to take a draw, and we're using up the cash. In his case, he was able to keep a lot of that cash in the business. So what we identified as a great strategy for him was to set up a 401k plan for his business. And in addition to setting up a 401k plan, I was able to help him set up one that had a profit sharing component. And a profit sharing component is kind of what I like to say is a 401k on steroids there, because here in 2025, the maximum that someone can contribute to a 401k through their paycheck is $23,500. What the profit sharing component lets you do is it allows the business to kick in an extra $46,500 employees 401k plan to the owner's K account, thus allowing that person to put away up to $70,000. And that's indexed to inflation. That changes every year. But the beauty is that $46,000 that the business is kicking in, that's a deduction for the business, thus lowering their profits that they need to pay tax on. So we are moving $46,000 into the owner's K, thus increasing their net worth while at the same time decreasing the profits they have to pay taxes on. So it's a win-win situation there. And so across Michael's business, between the money he put into his 401k, the money he put into his employees' 401k, we ended up saving him $68,000 taxes. And the thing that was most powerful for Michael was he had older children he had 3 daughters who were all of marriage age there. And whether it was that year or following year, he knew he had some weddings coming up there. And so, when I talk about, that my business is out to help people save money so they can reinvest in their families, that's what I'm talking about is, saving that money, not to send to Uncle Sam, but to use for the things that are most important in our lives there. Don't just check the box on retirement of saying, yep, I'm putting some money from my paycheck. Make sure you're looking with your tax pro. What's the most you're eligible to contribute? Does that make sense for your business this year? And are we maxing it out? And so if someone doesn't know where to start, Anthony, take a look at your entity selection. Take a look at that QBI. Are you maxing out the 20%? Are you eligible for P-TET and taking advantage of that? And then what's the most you could put into retirement? And are you doing that? And that's a great place for most people to start out.
That is awesome. So now the question is, what type of clients do you normally specialize in helping in?
Mm-hmm. Yeah, so I bring the most value to high net worth individuals and to small business owners. Tell you a quick story about a high net worth individual I'm working with. Individual earning about $300K a year from his W-2.
Mm-hmm.
And he got into real estate because, quote unquote, real estate is a great investment. There's tax advantages to real estate, right? And there are a lot of great tax advantages. But what most individuals who are just kind of dabbling casually in real estate don't understand is that the IRS categorizes the income or the loss that you get from real estate different from the income that you get from, say, your business or, say, your W-2. And Anthony, as you know, if you have a loss with real estate, that's called a passive loss, which is different from earned income from a W-2. You can't use a passive loss to reduce your W-2 income there. And so my client here thought he had all these tax deductions he could take, and he wasn't eligible for them there. And so in situations like that, what I like to do is just tell people there, okay, can we raise the rent there so that you have more profit there in the business? Do we need to get some additional rental properties coming along so that we have passive income from property 1 that offsets the passive loss from property 2? Do we own a business where we can segment a part of that business to make that department or that segment passive income to offset those losses there, and just make sure that we're fully taking advantage of those real estate losses we might have coming in and whatnot there. So yeah, that's a little bit about how I help out, whether it's a high net worth individual or a business owner there, specifically with real estate strategies,
right,
that we work on.
Real estate is very a hot topic item. And one of the things is that I always asked, am constantly asked, is should I put my house inside of an LLC or should I just kind of keep it under my own taxes? Can you just do a quick, yes or no with that one?
No, I cannot do a quick yes or no. No. So I'll throw out a couple of guidelines here. Again, please talk with your tax professional, talk with your lawyer about this because it's very fact dependent. That being said, Anthony, my experience has been for most people, if you just have 1 property, 2 properties, it probably holding them under your own name is going to be fine for you there. When you add in another LLC, you're adding in additional compliance, you're adding in additional paperwork, probably adding in additional costs there. In my experience, it's a lot of times the juice just isn't worth the squeeze there if we just have one or 2 properties. But again, please talk with your lawyer about that, because the key thing with the LLC is not so much of a tax play as it is a risk. It's an element of risk, and just making sure that your assets are properly protected there. And so that's much more of a legal issue than it is an accounting one there. But
Okay.
hopefully that was still some kind of a quick answer for you there.
Yeah, because it kind of wrapping up with that one is that it helps out for people to feel like if they're going to plan on starting, quote unquote, starting a business, what does
Hmm.
to constitute a business? Because if the business, quote unquote, is making money or is it not making money?
Yeah.
And then is it worth then should it be a hobby and stop reporting it for your taxes? Because at that
Hmm.
point, the business hasn't been making money for like maybe what 3 to 5 years. Like, is it at the 5 year point, if their business is not making money, should they even come to you at all? Or just kind of like just drop it?
That's a good question there. So, it really goes back to what's your motive
Mm.
for the business, and can you make a compelling argument that you're trying to make money with this? And so here's an example. I worked with someone one time that had a horse farm, and the farm had lost money for 20 years straight. And you look at the individual who owned it. They were someone who was very influential and very involved in the horse breeding world and in the horse training world, as it's probably what most people would call a hobby there. And when I would talk to them about, what are your plans for this year, right? Are we trying any new marketing strategies? Are we trying any new business strategies? No, we're just going to keep doing what we were doing there, attending trade shows, maybe breeding one or two horses. And, it's one of those things, like, if that were to come under audit, my sense is that the auditor probably would say, hey, this looks like a hobby, walks like a hobby, smells like a hobby here. You're not really showing that you're making an effort to try to make money there. Now, that's not the case for everybody, right? Some people, it takes a while to get your business going. You're trying different strategies, you're trying different things, going to different markets, different products there. So it really depends on the person's motives there, and whether or not we can make a compelling case that yes, this is a business. Because as you kind of were alluding to, the IRS does have the ability to come back and say, hey, we see no evidence that you're trying to make money. We are thus going to disallow these deductions there, and then you would have to pay tax on, that loss of deductions.
Now that's interesting. Okay. Thank you
Yeah,
for clearing that
yeah,
up because some people just figure out like, hey, should my lemonade stand actually get an LLC or not? Just call it
yeah.
a day.
Well, Anthony, I mean, something I like to kind of my litmus test for people who are saying, do I get an LLC? Or again, jumping back, one of those the initial stories I told about that woman Emma,
Mm.
who came to me and we said, hey, you're in the wrong. Your business is not being taxed efficiently. Kind of one of the litmus tests I like to use there is, what are your profits there? Again, every situation is unique. Please talk with your tax pro about your situation to make a decision. But it's been my experience that by and large, if someone has less than $50,000 of profit in their business, being taxed as a sole prop there is going to be the most tax advantage way for you to structure your business. Now, another thing to mention there, people a lot of times will throw out LLC and say, to a lot of people, LLC is just synonymous with owning a business. And that's not necessarily true from a legal standpoint. An LLC is just a structure for legal reasons that states allow you to have for asset protection. And you really want to take a look at your state to understand what the laws are around that. So, for example, people in California, you make $1, even if you lose money in your business. If you have an LLC, you have to pay a mandatory $800 a year fee to the state of California. And so, do you need asset protection? Are you making enough money that an $800 an expense a year is going to be worth it? There, um, are all things to be taking a look at, because some states don't charge that. And, aside from a couple of bucks to set that LLC up, there's not really an expense to do it and whatnot. But kind of bringing this back here, whether I'm holding myself out as is Kyle Beltley or Kyle Beltley LLC there, if I'm making $500 a year off my Etsy shop
Right.
there, it's going to be taxed the same way. The LLC really doesn't play into the taxes at that kind of those early levels. So just to kind of circle back, bring that together, if you're making less than $50K a year, they're probably being taxed as a sole prop is probably going to be the best bet for you.
Awesome. So, we're just going to move on to the third segment. Thank you for clarifying that up because I can definitely reference this episode because a lot of people do be asking, like, should I start an LLC? Is this an LLC? Listen to the episode. Just go back to Kyle.
Exactly.
Just look at Kyle. And let's get it going. So, what is the future of proactive CPA?
What is the future of proactive CPA? There, that is a good question. There, if you don't mind, Anthony, I feel like I could go in a lot of different directions.
Okay.
With that, tell me a little bit more.
Yes.
What prompted you to ask that question?
Well, because you talk about like how you work with hiring people, and then also you said small business owners. But considering that the way how a lot of people are actually either going out of business, people are actually getting laid off their jobs to start LLCs, and they are pretty much micro small businesses. Do you feel that there's going to be a shift in your clientele within the next year or two?
Anthony, no, I don't anticipate a shift, at least not for the reasons, not due to reasons of, say, unemployment or economic reasons. Honestly, the thing that am most concerned about today in terms of a shift is how artificial intelligence is going to be shaping what jobs look like.
Ooh.
In the next 5 to 10 years. What jobs are going to be eliminated, what jobs are going to be elevated, and what jobs are going to be created. And, I spent many, many years of my life helping people who ran marketing agencies where they were providing blogging services. They were providing SEO services. They were providing marketing strategies there. Those are all things very much in the crosshairs of AI today. I heard a conversation with an owner recently who said, I've got 3 writers on staff at my marketing agency. I'm probably going to just only need 1 going forward there. And so if I specialize in marketing agencies, what is that going to look like there? And so I think that maybe who I work with is going to shift and change in the future. But Anthony, as I've studied AI and studied history, we are an incredibly resilient species, and we have always found a way to adapt every time new technology comes and to shift. And I know that's going to happen again. And the people who are watching this and who are prepared for this and are going to be the people to use a historical analogy, going back to the gold rush, people who were going for the gold, a lot of them lost money, but the people selling the pickaxes, the people selling clothing and supplies, they all made a good amount of money on that. Who's going to be selling the pickaxes? Who's going to be selling the supplies here for those riding the wave of AI there? I still think there's going to be tons and tons of small businesses out there to continue to serve in the future.
So is there anything you want to leave the listener with before we dive into the final 4 questions?
Yeah. So one of the questions I get asked a lot is, when should I start planning for my taxes? When should I start preparing? And Anthony, I like to say, you need to start planning for your taxes on January 1st. From the beginning of the year, be thinking about your business and how the changes in your business are going to be affecting your taxes there, and talk with your tax professional throughout the year. Keep them appraised of what's going on with your business. Find out if there's any new changes to tax laws that could affect you there. because as I said at the top of the show, once you get to April 15th, really the only thing you can do is report the score of the game and kind of jot down what happened in the prior year there. It's only in the middle of the year that you actually have the ability to make moves to influence and to bring down your tax burden. So start planning and get proactive.
Okay, did that.
Thank you.
Right. Hey, you ready for the Final Four?
Yeah, let's do it. I love this part.
Awesome. All right. So for those of you who are new to the show, the Final Four questions are the Final Four questions that we ask every guest at the end of the show, just to kind of dig in a little bit more about what they like about money or don't like about money. So question number 1, what does wealth mean to you?
So I really like the definition that the comedian Jimmy Carr gives. If more income, if more money wouldn't change how I live or what I do, then I am rich. And I really like that there. That's once you are at a place there where, the house that you live in, the cars you drive, the vacations you go on probably wouldn't change too much there, then you're rich. And, I think most of us have a lot more than we realize and are blessed a lot more than we realize. And focusing on that brings me a lot of happiness, brings me a lot of joy.
Number 2, what was your worst money mistake?
Man, you need to do a greatest hits episode of just mistakes that people have made. Well, I'll tell you a recent mistake that I made that really just frustrated me and made me do a face palm there. And that was with a marketing campaign that I had paid for my business and just did not do enough due diligence on. And I just felt like I paid for junk. I got zero results from it and I just lost that. So that was just incredibly frustrating as a business owner to feel like I had just flushed money down the toilet. But I suppose if there's ever a silver lining to these things, you learn from the mistake and you don't make it again.
Yeah. How much, if you don't mind me asking, did you pay?
So in full transparency, it was only $500. It wasn't a ton of money, but as a business owner there, every dollar feels like $1 million.
Yes. You don't know how many services I had to pay for this thing?
Yeah, exactly.
Number 3, is there a book that inspired your journey or changed your perspective?
So there have been many great books, great audio programs that I've listened to over the years. If I had to point to one that I view as being the most influential, I would probably say Earl Nightingale's The Strangest Secret. Have you heard of that one before, Anthony?
No, not on this show.
So the Strangest Secret, it's actually, if I recall correctly, it was originally a radio program that Earl Nightingale recorded back in, I want to say the 40s or the 50s there. You can look it up on YouTube. It's only about 30 minutes. Well worth your time to listen to. Earl's got this great, deep radio voice there. It sounds so good there. And you got that crisp analog sound from yesteryear. But the reason I like to cite The Strangest Secret is because it was really the first time that I was exposed to the power of positive thinking, the power of having goals, and the power of really being focused with what you think about. To give away, spoiler alert, The Strangest Secret, Earl says, we become what we think about most of the time. And that was really one of the first times I was ever exposed to those concepts there. And yeah, even to this day, I still find it as a great reset if I need a little motivation or just kind of feeling stuck in business. So yeah, really encourage people to check that out. Strangest Secret, Earl Nightingale.
All right, I'm going to have to check the read along on YouTube then.
So, Please do.
Number 4, what is your favorite dish to make?
So I would say probably my favorite dish is pancakes.
Really?
Believe it or not. Yeah. A couple of years ago, I just got obsessed with why is it every time I go to a diner, the pancakes are amazing, but when I make them at home, they just taste like cardboard? And so, yeah, I just kind of went
Please
on this
share the
journey
secret.
of, what'd you say?
I said, please share the secret.
Yeah, so I really went on this journey. So to kind of create my own recipe, create my own technique there. So some of the things that I like to do, the quote unquote secrets, buttermilk. I always like to use buttermilk when making the pancakes. Also, uh, you mix your wet ingredients, you mix your dry ingredients, and then when you put them together, do not overmix them. They're, it shouldn't be a silky smooth texture. It should almost be like a lumpy texture. You just want to be very gentle with combining those ingredients there, and that helps keep them a little lighter, a little fluffier. And then along with that buttermilk, there just gives it a nice tangy taste there, and think they're phenomenal. So yeah, if you ever stop by our house on a Saturday morning, Anthony, very good chance I'll be making some pancakes here.
Awesome. Man, like you said, you got to be proactive.
That's right. Yeah, absolutely. Absolutely. Well, thank you so much for having me, Anthony. It really has been a pleasure talking with you.
Yeah. And it comes down to the last question, which is where could people find out more about you?
Yeah. So best place to find me is at my the best place for people to find me is at my website, proactivecpa.co. That's proactivecpa.co. I'm very active on LinkedIn, and you can connect with me there through my website. I also have a blog on my website. So if you got any tips out of today's podcast and you'd like to follow along for more tax tips, that's typically what I like to post online and post on my blog. Just, very recently had a post on, can you combine business travel with personal travel and get some write-offs? So if topics like that interest you, please stop on by and you can find all kinds of great stuff.
Yeah, I need to do that myself.
Yeah, exactly. How can we get some business write-offs?
Right. So, Kyle, thank you so much for stopping by. And this was fun,
Yes.
exciting, and actually, I mean, I know we said taxes are boring in the green screen, but we made it fun now. I think we made it
Yes.
fun.
I,
Yeah.
I think we did. I think we did, Anthony. And yeah, again, thank you so much to you. I really appreciate you reaching out and having me.
For you who are listening right now, I just want to make sure that you got everything that you needed. So please, thank you for listening. I want you to go ahead on and check out if you want to check out more episodes like this, go ahead on and subscribe. Leave a comment on Spotify or even on YouTube, because it really does help me understand, like, hey, was this topic good enough? Do you want to bring on more people like Kyle? Or do you want to have different topics? If you want me to do a deeper dive, I can try to see if we can get Kyle back on, because he's so proactive for the year. He might be busy.
Yeah, I'd love that.
Awesome. All right, everybody. Y'all be safe. Yep. Peace.